Hi, I'm Simon again, and we are going to talk a little bit about capital growth versus cash flow. Had this with an investor recently, and trying to get that balance between what you need today and what will be the best way of investing over a long term is a really hard balance. And I certainly think that capital growth, traditional buy-to-lets and other assets in that are better, and you will get better returns than just purely looking at day one cash flow. So it's hard to show, it's hard to describe at times because the capital growth is an assumption, and that's not just based on national stats, that's based on areas that you or we are trying to work out are good areas for that capital growth. I'm going to go through some numbers, and they're really sort of rough, broad numbers there, and that I've sort of assumed and done some bits. I've worked it on a couple of deals that we're looking at. So there's a buy-to-let that we're looking at in Pudsey, and there's some HMOs that we're looking at in Barnsley. So areas that, it's not just the areas that have got different types of growth, one's near Leeds, one's in Barnsley, it's also the asset class and the wear and tear and the demand on those properties as well. So purchase price, I say I've got this as a purchase. This is probably what the property is actually valued at or worth if we were to buy it. So we've got 110, 185k. So again, I'm using these examples as purely because value property and get a higher yield and a higher net cash flow. But what you aren't going to get is the same capital growth in an area that's already shown that capital growth and is some good house property values against one that hasn't grown as much, has got room to grow, granted, but isn't going to do the same as this. This one's on the edge of Leeds, in a nice area with good schools. This is on the edge of Barnsley. So net rent per month is 235 on this one. So that's after your mortgage at 5%. And this one again is 800 after we've rented out each room individually. So obviously massive difference day one of net income. What I've put here is 5-year works. Again, this is a really subjective figure in terms of what it could be, but you're going to have to refresh and do a HMO quite considerably after 5 years. The wear and tear is enormous. Certainly in that value areas where you're going to do blue collar workers, although we've done HMOs with white collar workers, i.e. professionals, and they get the same wear and tear. So I've got it down as every sort of 5 years, you're going to have to spend probably 10k or so to tidy up the kitchen, some carpets and maintenance. So in this 10-year period, we've got 5-year works, but we're going to go on a 10-year period. We're going to assume 20,000 quid worth of works to maintain and upgrade that property. And that's not probably even including when the cooker breaks down and all the other bits and pieces that goes on in a HMO. With a buy-to-let in a good area, it's likely the works will be low, if any, with tenant turnover. We've got EICRs to do, so electric tests every 5 years. We've got some gas certs every year, maybe some freshen up with carpets and what have you. So we're going to go over the 10-year period, 5 grand. Now, don't get me wrong, if you get a bad tenant and they trash the house, that goes out the window. But we're doing some assumptions over the 10-year period that you'll have to do a little bit of works on there. 10-year net income is 28k. And again, I've rounded the numbers up just for ease. And here is 96k. So that's the total income over those period of times where, based on that over 10 years. So you can see considerably the income, the cash flow is a lot higher. But this is where the interesting bit happens. So compounding capital growth on this number, based only at 5%, which is conservative, I think, for the edge of Leeds, 115k growth. So that property value will likely go up by 115k in the next 10 years. I think that's conservative. It could be more, but that works. HMOs and properties in Barnsley, so property in Barnsley probably won't go up as much, but also HMOs that have had loads of wear and tear as an asset is likely not to go up much at all. We're probably looking a minimum amount as that has been there for about a 10-year period already, these sort of house prices in around that area for this type of property as well, that are looking at lower value with a higher yield. So we're just going to go conservatively, or I say conservatively, like a £20,000 cap growth estimate. So that's actually, that capital growth is probably offset by the fact that we're going to spend that on the property anyway. So we're looking at total returns in that period. Again, crude figures, don't pick me up on every little bit that could be either pros or cons against this, but you're looking at a 96k income on that property, and that's purely from income and capital growth. Purely from income because the capital growth's offset by the money that you spend on the refurbs. But the nicer sort of 3-bed buy-to-let on the edge of Leeds in Pudsey with the capital growth and a little bit of the net cash flow and the income. So you're looking at a net income of, after you take a little bit of works in, of 138k. So you're looking at quite a big difference there of a £44,000 difference over a 10-year period. So you're looking at a 44k difference just on a simple buy-to-let by looking at the 10-year picture. And obviously that will then compound as you go to 15 years. That this number would be big on the 15-year period as well because they'll grow apart. So there's a place for HMOs, there really is. There is a place for adding value to them and doing some bits and using them as commercial assets. I'm not saying don't do them, but I also think that we need to really look at both asset classes, having a balance in the portfolio. So I'd never say don't buy any HMOs, I'd never say don't buy buy-to-lets, but certainly from a simplicity and ease perspective, and I think a bigger picture perspective, buy-to-lets in the right areas really work. If you're buying a 50k house in Durham, and again, looking at yield, you're not going to get these types of returns. But what we're always trying to do is we try and buy at discount, get a little bit of income, and look at that capital growth area, try and hit that sweet spot. We haven't factored in here is effort costs effectively, so the amount of energy and effort it takes to look after a HMO in comparison to a buy-to-let as well. So your time, I think, is better spent and well spent on the simplest, easiest. They're just not quite as sexy and attractive day one, and that is what I've been trying to get across to clients and customers recently. So they're the two examples. Let me know what you think.